Okay, we're live now. Okay, so relax, just be yourself, and we'll record what we do here. So we have the adjusted trial balance of Brady irrigation system, and it's as of December 31st, 2014, and it's in this little link. So we can take this up here, and this is an adjusted trial balance. And what they want me to do is they want me to first prepare the company's income statement for the year ending December 31st, 2014. So you guys should be able to kind of look at a trial balance and identify which accounts belong on this income statement, right? And like I said before, a lot of times if this is done, if this trial balance is put together in a way that an accountant who has been working for a long time would do it, these accounts would already be categorized in the order of assets, liabilities, equity, revenue, and expenses. So I'm going to kind of eyeball it real quick. Okay, I see assets here, and then I see liabilities starting here. Then I got my equity starting with common stock. Okay, so that looks like it's all balance sheet from dividends up. Okay, from dividends up, it's all going to end up being assets, liabilities, or equity. And then I hit revenue. So revenue belongs on the income statement. And then I have all of these expenses. So I feel pretty safe that I can, even if it was pencil and paper, I probably would draw a line right here after dividends, right across. Can't really draw a line here. So I can show the separation between my income statement items on the bottom and my balance sheet items on the top. So I'm going to start with the balance sheet. And we're going to have revenues, and they call the revenue, the only revenue they have is called service revenue. So 74,600 will be my service revenue. Okay? And then I'll have my expenses. And then I can basically take all of these expenses and list them. Now, I'm going to do this in the order they have it on the trial balance, but out in practice, we probably would list the larger expenses first and working their way down to the smaller amounts. Okay?
Should we do that on the test? Does it matter?
Why don't we try that here? Okay, I don't think it'll make it wrong. I'm just afraid that they might want it that way. So I was going to just do it in this order. I don't think it would make it wrong if we listed it that way. We'll do that. Why don't we do that? We'll start with salaries expense. And that's, mine is $15,600. And the next biggest one is this $2,000 one, depreciation expense on the equipment. And then I got $1,600 for depreciation on the building. Then I got, let's see, $1,200 for supplies expense. Make sure you really be careful too. You don't want to get something that's not an expense. Sometimes they have the same first word in them, right? So you want to make sure you get the expense account. Then we got $600 for interest. And then it looks like we got $500 for insurance.
Interest?
Did I skip interest? Well, one way to make sure you got all of them is count them, right? 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. So I think I got them all. Then I'm going to add them up. So I'm just adding up the expenses now. Oops. So I'm going to start with my 15,600, 2,000, 1,600, 1,200, 600, and 500. So I got 21,500 in total expenses. So that's going to be put in right here, and we're going to label that total expenses. And then to figure out net income, we're going to take the difference between the revenue. So 74,600 minus the 21,500. In my calculator, I'll just hit minus here. It's going to end up being a negative number, but when I eyeball it, I know that it's supposed to be positive, right? It's just the difference. So 53,100, and take that negative sign off of there. Let's see. There you go. Did it not work for you? I got well done. So we know that we can put it in descending order. Maybe one of you that's out there working on it right now, haven't hit enter yet, maybe put a couple of them out of order and just see if it works. I'm sure it's going to work, but what I'm saying is out in practice, this is the way we would list the expenses from biggest to smallest. Okay? Right?
I didn't order they were, and it was fine.
It was fine, right? Yeah. So the program's not so finicky about it that way. Just be aware when you go out to work, and if you're going to prepare a formal financial income statement, you want to put it in descending, larger to smaller. Yeah. Okay. Then the second thing we do, let's get our trial balance back out, right? We're going to prepare the statement of retained earnings, right? Remember now, the statement of retained earnings is going to start with our beginning retained earnings balance, right? And then it's going to work its way down. We're going to add net income to that, and we're going to subtract dividends. Okay? So really, three factors that go into determining the ending retained earnings. It's your beginning retained earnings plus net income minus the dividends. And then we put it into this financial statement format. So my beginning retained earnings will come from this trial balance. And the reason I know that it's the beginning retained earnings is because all of these other items that go into retained earnings, revenues, expenses, and dividends, are still sitting there with balances. So that tells me that those numbers are not rolled up into this retained earnings figure. So I'm going to use my 19,000 as my beginning retained earnings balance, right from my adjusted trial balance. And then what do I add? In this case, I'm going to add the net income, and that will come from my income statement. So I'm going to add my 53,100. I just highlighted it here, right? So that 53,100 is going to show up there. And then what we normally do is we make a subtotal. Sometimes they even put the word subtotal in here. So we would have to add the beginning and the net income. So what do I have? 72,100. Looks like it, yeah. And then what do I do next? Anybody? Subtract, right? We're going to subtract dividends, yeah. Remember to subtract dividends. So dividends will be subtracted. Now I think we might need to show this as a negative because there's there's nothing saying less dividends, right? So I'm going to show my dividends as a negative. My dividends come from the trial balance here, 27,000. I think you can use a minus sign or you can use parentheses, either or. So if we were to subtract 2,700, not 27,000. So if you took the 72,100 minus 2,700, you got 69,400. Check your answer. Okay, I got well done. Did everybody get well done? Good job is just as good as well done, yeah. I think fantastic is the best, but I guess they use them all the same, right? Okay. Then finally, we're going to make our balance sheet. What we got to remember is our balance sheet. In this problem, they're giving it to you in sections. So we got to start with our assets. So we're going to have what we call current assets. Do you remember the definition of current assets? Well, anything that we're going to turn into cash, or in other words, liquidate, or anything that we're going to use up within 1 year. Okay? So the 1 year is the cutoff, right? If it's anything that's going to last longer than a year, then that's a long-term asset, right? Non-current asset. Okay? So we can look at them here right from the trial balance. I know I'm going to have cash. I'm going to have accounts receivable, office supplies. I'm going to have prepaid insurance. I'm going to have, okay, now equipment is not going to be in the current asset section. Okay. Now with assets and with balance sheet items, we don't list them in the largest to smallest order. We list them in the order of liquidity. So liquidity means how quickly they're going to be turned into cash or how quickly they're going to be used up. So of course, cash is the most liquid asset because it's already cash. Accounts receivable is closer to being converted to cash than office supplies. And then it goes on that way. So these are pretty much in that order already. So these will be my total current assets.
Is buildings an asset?
Building's an asset, but it's not a current asset.
Okay.
So it's going to go into a different section of the asset category, right? Notice we're only working on the assets right now. So there's more room for the other assets, right? So we're just getting that subtotal for the current assets. So we've got to add those up. Let's see how that works out. I got 108. You got different numbers than I, though. Okay. Then we're going to move down to they're going to call them plant assets. They're not current assets. They're the fixed assets that last longer than a year, or we're not going to convert them to cash within a year. Okay, and that's going to end up being the equipment, one of them. So let's find the equipment. Equipment is 27,000. Okay, and then what we do is we list, like I was telling you the other day, we're going to list the accumulated depreciation, right, on that equipment. And that's a contra asset. Okay, so we need to subtract that from equipment. Okay. So this is the way you present your long-term assets. 27,000 is the cost minus the accumulated depreciation. That gives me 19,600. Okay.
What did you say plant assets were? Like,
Plant assets are things that we will not liquidate within a year. A lot of times it's things like equipment, building, trucks.
liquidates turn to cash, right?
Yeah, turn to cash, right? Okay, now I'm not sure if we got to make that 74 negative, but just realize you're subtracting that. So we'll use my submission as the guinea pig on this. Now the next thing we have is building. So the building has a cost of 61,000 right from the trial balance. And then it subtract accumulated depreciation of 24,000. Okay. You know, I kind of think I like to show it as negative, so I'm going to put it in parentheses. My arrow keys don't work. Yeah, they don't go. Okay. So 61,000 minus 24,200 gives me 36,800. Okay. So if I combine the net equipment, which is 19,600, and the net building, which is 36,800, that's going to be my total plant assets. Okay. So we'll just add those two together. And then if I add my total plant assets to my total current assets, that will be my total assets. Okay. So I got 164,400. And I got it right, and looks like they probably did want the either parentheses or the negative sign. I think if you put the negative sign, it's going to automatically put in parentheses for you. So you can try that. Okay. So far, so good. Okay. Now we're going to do the liabilities and equity. So again, we got to do current liabilities. So our current liabilities is anything that we're going to pay off within 1 year. Okay. So when I scan down here, liabilities start here with accounts payable. Then I got interest payable.
You didn't put the parentheses at the.
I put the parentheses. Did you not put it and it came out all right?
We did.
My calculation.
You didn't put it and it came out all right.
Yeah.
No, we did put it in.
Oh, you did. Did anyone not put it?
I didn't put it.
And-
You can't put
yeah.
it.
Because it has that word less in there. I believe it's automatically going to make it negative for you. Yeah. But just so we're all sure, we got salaries payable. Watch out now, don't grab salaries expense by accident. Get salaries payable. Because salaries expense is on the income statement. I got unearned revenue. Remember, unearned revenue is a liability, even though it doesn't have the word payable next to it. Okay, those are the current liabilities. Because notice, next to notes payable, it says long term. So a long-term note payable would be paid off over probably many years, but longer than a year. So I'm only getting the stuff that's going to be paid off within a year. And then I can drop those numbers in. So accounts payable is 38,400. Interest payable is 600. Salaries payable is 4,100. Unearned revenue is 1,900. And that's going to end up being my total, right? Total current liabilities. So don't let the fact that you have an extra space there make you think and keep spinning your wheels looking for another item. In this case, that's that. That's all there is. So 38,400 plus 600 plus 4,100 plus 1,900. Okay. 45,000 in current liabilities. Now I'm going to have long-term liabilities. So that's going to be my notes payable of 32,000. So I'll call that notes payable. Okay. And since there's only one long-term liability, because the next thing is common stock, and that's in the equity section, we're going to just call that the total long-term liabilities, 32,000, and we can add that to the 45,000. So we'll have 77,000 in total liabilities. Okay? And then make sure, at least with your homework here, don't hit enter yet, because we still have to do the equity section, right? So the first thing in equity is what? You guys remember? First item in equity, common stock, right? So I can get my common stock from my trial balance here, 18,000. And then what's the other thing in equity? Yep, you got it. Now this is where we got to be careful, because we're not going to use this retained earnings. That's the beginning retained earnings. We got to scroll back up. Remember, those financial statements are prepared in order, in this specific order, because we have to link net income via retained earnings to the balance sheet, okay? So I'm going to use my ending retained earnings from the retained earnings statement, 69,400. That's going to be my ending retained earnings, okay? And then if I add those two, right, I'm going to have 87,400, okay? And that will be what we call our total stockholders' equity, okay? So far, so good. Okay. No, stuck. Somebody? I can go ahead. Okay. Now, I gotta add the total liabilities to the total stockholders' equity, and when I add those two, that number should match my total assets. Okay. If it doesn't, then we did something wrong. So we'll do that real quick. I'm going to take my 77,000 in total liabilities, and I'm going to add my 87,400 in total stockholders' equity, and I get 164,400. Before you even type it in or whatever, take a look back up at your total assets. Make sure that that's the same number, and in this case it is 164,400. So I think that's a pretty good number. I'm going to put that down here, and that's going to be called my total liabilities and stockholders' equity. So remember, the balance sheet is it's actually exactly like the accounting equation. We're just running this thing vertical. Assets, my total assets here, 164,400 equals my total liabilities plus my total stockholders' equity of 164,400. Okay? Everybody okay with that so far?
Not much, but doesn't say well done this time. I don't know.
It didn't give you any kind of affirmation or confirmation or validation? Okay. Well, if you got it wrong, then it's gonna, if you get any of these numbers wrong, and I think if you click 3 times, you're gonna end up with little red triangles in the corner. It's gonna show the right number in there, but then it's gonna, if you hover over that little red triangle, it's gonna show what you entered. So it's gonna show what you entered, which was wrong, and then the actual right number is gonna show in there. Okay. And then in that situation, you would only get partial credit. You'd have to redo the problem to try to get 100%. Okay. Okay, we went over this the other day. Remember we did the closing entries? Okay, so the first thing they want me to do is close revenue. Remember, if you looked at your trial balance here, revenue has a credit balance sitting here on the right, 74,600. So to close revenue, I gotta debit the revenue account. So I'm gonna debit service revenue. And what account do I credit? Do you guys remember? When I close revenue? Exactly, income summary. Right, so I'm gonna credit income summary, 74,600. And then it wants you to put a little memo in down here. So this is to close revenue. Okay. I got nice work. Okay. Now it wants me to close expenses. So remember, expenses have debit balances. So I'm going to have to credit those expense accounts. And then I'm going to debit income summary. So I might as well put in my income summary account first, because that's going to be where the debit is. And then I just have to list all my expense accounts. So I got insurance expense. I got salaries expense. I got supplies expense. I got interest expense. I got depreciation expense on the equipment and depreciation expense on the building. Okay. So what I'm going to do is I'm going to bring those numbers over here. So, and this is a journal entry. So with a journal entry, it doesn't matter what order you know, from smallest to largest or largest to smallest or mixed up. It doesn't really make a difference unless you're very, very particular individually and you want everything lined up exactly, okay? So the total of my expenses is what I'm going to be debiting to income summary. To save us the task of punching it in the calculator again, just think, where could you find the total expenses? We did it earlier. If I scroll up here, right on my income statement, I got the total expenses sitting there, 21,500. You probably could even copy it. Try highlighting it and right-clicking with your mouse, copy to clipboard, and then let's see if it lets me paste it in here. There's no paste function. Okay. 21,500. Okay. Don't forget to put the memo in to close expenses. Okay? Now, if you kind of look at this thing, right? There's a debit of 74,000 to income summary, and there's a credit, there's a credit of 74,600 to income summary, and there's a debit of 21,500. So if you envision a T account, you would have that income summary account sitting there. Why don't we borrow this here? Wipe all of this out, right? If this were your income summary account, so call it income summary, okay? That first entry would have put a $74,600 credit to income summary, right? If you posted it, that would have been the revenue that we posted. See the revenue, right? Credit to income summary. And the second entry would have put a 21,500 debit to income summary. So that would be the expenses. Okay. So if I were to figure out what the balance in income summary is, I would probably like draw a line like that, and then I would get the difference. Now the difference is going to sit on the credit side because there's more credit than debit. So this is the balance in income summary. That's also your net income, if you think about it. This account is to summarize net income. It's called income summary. Look back over here, 53,100. Look at your income statement, 53,100. Okay, but we're still doing the bookkeeping here, so we need to eliminate. We need to eliminate the income summary account. So what we're really doing is we're going to debit. We're going to debit the income summary account for whatever the balance is, and the balance is 53,100. And what are we going to credit? Do you guys remember? What do I credit when I close the income summary account? Retained earnings, right? And it also shows over here on the retained earnings statement, right? You're rolling net income up into the retained earnings via the retained earnings statement. We also have to make a journal entry to reflect that. So we would be crediting retained, I'll just abbreviate, retained earnings, okay, for that 53,100. So that's the entry. And when we post this entry, when we post that 53 debit here, right, our new balance will be 0. Our income summary account's balance will end up being 0, okay, when we do post that entry. Okay, so I'm going to go ahead and make that entry I showed you in Excel there. You see the debit, this guy here highlighted in gray, debit to income summary, and credit to retained earnings, and we said 53,100. That's to close income summary. And to be more specific, it might say to close income summary to retained earnings. But that's fine. Okay. Then closing dividends is easy, right? Dividends have a debit balance. To get rid of the dividends account, I got to credit the account for that balance. So I know I'm going to have a $2,700 credit to dividends. And then what do I debit? Anybody remember? Retained earnings, right? And that's the same, right? That debit is reducing retained earnings. So this is to close dividends. Okay? Questions so far? Okay. Now they're throwing a ratio in here. A ratio is an analytical tool that we use to judge the company's health. Okay, and in this case, what we're going to be judging is liquidity, right? Liquidity means, you know, how quickly, you know, first of all, liquidity is how quickly we can convert our assets to cash, right? But broader than that, we want to know how quickly we can convert those assets to cash so we can pay the liabilities, the current liabilities that are coming due. So what we do is we do this ratio that compares our current assets to our current liabilities, right? We want to see, in relation to our current liabilities, what are our current assets? So we're going to just basically divide current assets by current liabilities, and we want that number to be 1 or greater, right? If you have less in current assets than you do in current liabilities, then if that continues on chronically, eventually the company is going to fold because they're going to run out of money to pay off what's coming due, okay? So this is a pretty simple ratio. We're going to take total current assets and we're going to divide by total current liabilities, okay? And this is called the current ratio. Just go back to your balance sheet, find your total current asset figure of 108,000 and your total current liabilities figure of 45,000. Okay, so 108 divided by 45,000. Okay, and if you took your calculator out, you could go, right? They have 3 zeros at the end, so I can kind of truncate that. 2.4. So you have, in your current assets, you have 2.4 times the amount that you have in your current liabilities. So this company is pretty well equipped to pay off its obligations that are coming due currently, okay? Now they want to ask this one last question. Since the current ratio was 2.5 1 year ago, Brady's ability to pay its current liabilities has, I would say, deteriorated, but not by much, by 0.1, right? So it deteriorated, but just a little bit, okay? Let's see. And that's that, right? That's the whole problem.